Right, now let's gonna look at question. I think it is A2, which is on IFRS 15, right? So we are still at the mock 3. So here we've been asked to use Exhibit 2, discuss the principles that should be considered by Luna Company in recording the sale of the goods to the Starlight Company in Luna Company's individual financial statements for the year ended 31st March 2016, right? That means they're saying should be considered the principle that should be considered. They're not asking us to say what will be the accounting treatment. They're just asking us the principles that means the accounting standards that will apply for this, right? Where a Luna company is recording the sale of the goods to Starlight. So Luna company has sold goods to Starlight, and so it is in the individual Starlight company in the individual Luna's company's individual financial statements for the year end. So this was not about consolidated financial statements. They're saying here we have Luna Company, the parent, in its individual financial statement, and Luna Company has sold goods to Starlight Company. So how that sales need to be recorded in the Luna Company's individual financial statements, nothing to do with the consolidations, right? Let's read the first, but let's get one by one, right? So we still don't know what accounting standards that need to be applied, right? So here it could rough idea here. When we sell goods, that means we wants to know from our side, Luna Company side, Luna Company need to recognize the revenue, right? So that would give an indications that we need to focus on IFRS 15 revenue recognition, right? That's the starting point. Let's read this. They're saying on March 2000, 20th March 2016, Luna Company sold 5,000 units of product A1 to Starlight at an initial transaction price of 200,000 per unit, right? Right. So this is the one. So suppose if this sales was correct, what I would have done 500,000 units times 200, and I would have recognized that as my revenue, $1 million as my revenue. That's how I would have recognized it, right? So it is not that straightforward when you do revenue recognition, right? So we need to first know the rules with respect to revenue recognitions. Let me first also to parallelly I do this together, right? So here I have the IFRS 15 revenue recognitions notes together, right? So it's much easier for you to understand. So what we need to know when we're dealing with revenue recognition, revenue must be recognized only when the performance obligation is satisfied. Here, the Luna company, they they sold 5,000 units, right? We don't know what was the units they sold. It was 5,000 units of product A1, right? So that they sold the units to Starlight. So the performance obligation, they need to complete their performance obligation. So when they complete the performance obligation phase, Luna company must send those goods over to Starlight company. So the important word here, right? The performance would be completed only when the control has been fully transferred. So here, this is the lecture notes with respect to this on revenue recognition, right? So when that we need to recognize the revenue, when the transfer of control to the customer from the entity supplying the goods of services, when you transfer the control of that goods, that means the risk and rewards related to the goods has been given to the other party, right? The other party has the control over these goods. Starlight has the control over these goods. If those control has been passed to Starlight, that would be the point where Luna company need to recognize this. Now let me also show you the answer on the first paragraph. So here, revenue should be recognized when a performance obligation is satisfied. That's IFRS 15. This can be over any point of time. So since the risk and rewards of ownership of product one passes to Starlight on 20th of March 2016, it is right that Luna company should recognize revenue at this date, right? And not when the Starlight sells the goods to the final consumer. So now let's come back again. Let's read this. So here we were told, right? Here we were told when we need to know when that control got passed, right? So we sold goods of 500,000. I want to recognize the revenue 500,000 times 200, 5,000 times $200, 1 million. You know? So I just need to record that amount, right? I just need to record that 1 million in my books. right? And for that, the control of goods passed from Luna Company Starlight on that day, that means 20th of March. So according to IFRS 15, performance obligations has satisfied. I have sent my goods to the Starlight Company, and I have given them the control, right? So that means I should have recognized on this day, I should have recognized the revenue, 500,000 units times $200. I should have recognized the revenue at $1 million. So this is what they would have done, right? Let's move on further, because there are some other aspects that we need to consider now. Right? There are some other aspects that we need to consider. So this is where the next part of it I would explain, and then we'll go back to that particular. There is something called variable considerations, right? So the problem here, the transaction price is this $200, right? We want to know whether the transactions price that we have determined to measure the revenue is the right one. So what does the IFRS 15 rule says? Rule says, if these, when we determine the transaction price, the effects of these following items need to be taken into account, right? The effects of the following factors need to be considered when you determine the transaction price. That means when you determine this price to recognize your revenue. One of those items is what is known as variable consideration, right? So what is variable consideration? The price keeps on changing. We are not keeping one price, right? So after some time we are giving more discount, so the price keeps on changing, right, for some reason. So that's a variable consideration, right? So now let's see what has happened, and after that I'll come and explain this variable consideration, right? So here, so now if you read this here, it says here, so the product 1A has a high risk of obsolescence, right? And therefore price concessions are regularly granted in order that the goods can be easily transferred on within the distribution channel. So that means what we are saying now, because of its obsolescence is very high. So we have to keep on giving discounts to the buyer, to Starlight. Then only that they can make profits when they sell those goods to their final customers, right? So the price keeps on changing, right? So this is a variable consideration issue that we are dealing with. And they're saying on the basis of past practice, Luna Company practices anticipate that it will grant Starlight Company a price concessions of between 8% to 38%, right? We just need to pause there. So they're saying when you look at the past practice, in the reasonable past, when he gave discount, and it shows that we are giving up to 8% to 38. Maximum history shows we have given 38%, and then the lowest discount that we have given was 8%, right? Now we need to know how to determine this variable considerations. What is the correct price after this discount? I need to determine the price in a discounted price. So what is the best price when you have a variable consideration? And this is the conditions that we have, right? Let me highlight that, and then I'll come back to the other 2 points in a minute, right? So the standard says when you determine the variable, in order to decide how to determine the variable considerations, right? See here, to measure the variable considerations. I want to measure my variable considerations. I need to measure it, right? What is my price after discount? What is the best price after discount? So it says the best method is that using an expected value, right? Using when you see larger number of contracts being there and discounts being given, similar characteristic discount being given. So the best price is to use the expected value with when you've been given a probability weightage, and you can use the expected value. So we know it's the best to use the expected value by looking at the past concessions, discounts that was given. So we know in the history, right, according to these questions, in the history, only 8 to 38%. From 8% is the lowest, 38% is the highest discounts being given, right? But they have not given us any weightage. We need to know the probability to find the expected value, right? So we are unable to get that probability. And so what we need to do in order to get the expected value, so it is the most reasonable approach there for us, best approach there for us to get the midpoint price. This is the midpoint price. So this is the midpoint of that concession discount that we're going to give. So we know the lowest is 8, highest is 38. So the midpoint has to be 23%, right? What is this 23%? This is the discount that we would like to give by looking at the expected. We want to measure the expected value. We did not have the probability. So we found this is the most reasonable way approach to find it, that expected value. So we know 5,000 pounds was the original goods and the goods that has been sold, but we know the original price was $200. And now, because of the price being changing, variable consideration is there that need to affect our transaction price. So the transaction price can't be 200, then it need to be lower. Why? Because we have, it shows that discount would be given. So this transaction price is reduced. 23% discount means 77% is on the 200%, is that on the $200. So if you discount is 23%, so the remainder is 77%. So the new price is not 200, it would be reduced. So the new price is only $154. That means after taking the 23% discount. So if you just, what I was meant saying, if you take $200 and then you take the 23% discount, how much is it? That is 46 pounds. If you deduct, your existing price was 200, you're going to give discount now because they can't sell. So the actual price would be only now 154. So the standard says if you're using the expected value, you must be measuring your revenue at 154 times 500. So your new revenue, your revenue you should have recognized at 770,000, not at 770,000, and this is not at 1 million as you've recognized, right? That's what we are trying to find out. What we are trying to find out, how much I need to recognize as a revenue. In the books, we have recognized as 1 million, but then there are evidence of considerations being changing, prices being changing. That's known as variable considerations. So there are two ways in which the variable considerations need to be measured. The most suitable one is the using the expected value. And we know even though we don't have other data to find the expected value, probability is not there. We use the midpoint price to use the expected value. That's one. But then what is important here? The conditions, right? What does this condition says? If you want to use these variable considerations, but you must prove that it is highly probable that the significant reversal of cumulative revenue will not occur. That means, at this percentage, when you give 23%, you must be it must be highly probable, right? That there will no more a reversal is required, right? That means the revenue price would not be reduced further. There will be no more reversal will be required. You must be highly probable, right? If you can say at 23% discount thereafter that you're highly certain, highly probable that this price would never be this is the final and there will be no changes in the revenue. If that was the case, then you can determine this as the revenue, right? But then if you read the question further, but if you read this question further on here, and in this question it says there is high risk of obsolescence there, right? Because we have a high risk of obsolescence is there, and they're saying therefore the price concessions are regularly granted in order that the goods can be easily transferred within the distribution channel. So now because of that, we are now saying it is not possible for us to use the expected value and then to take 23% discount, right, from the price. Why? Because there is evidence of high obsolescence with respect to these goods that we have given, and that means that these prices would be reversed, not at 23%. We can go up to maximum of, we are ready to go up to max. In the past, we have gone up to 38% maximum discount being given from the price. So the revenue will be far less than what we are just thinking at discount at 23. So there is a high risk of obsolescence is there. So because there is high risk is there, that means, at this price discount, I cannot guaranteely say this revenue would not be reversed. Why? Because 38% is the maximum discount that I have given in the past because of the obsolescence, which was high. So that means this expected value calculations I cannot apply. So you need to discuss them one by one, right? So that's the second part now you would discuss here, right? So the first part that I've said to you, the second paragraph, you clearly say to you, right? You clearly say if you're using the expected value, you would have measured them at 23% like we did, and then you would have recognized that 770,000, because if you're using the expected value, right, that's the most suitable expected value is most likely that we should have used, right? And we could have used it, right? But the problem here with the 23%, and we cannot, it is not highly probable, that it would not reverse. That means, and it is possible this revenue, we can give more discount because of obsolescence, high risk of obsolescence. Then we may give price can change even further down. We can reduce, we can give more discounts further down. So that means we cannot guarantee say this would not reverse. It is not highly probable that it will not reverse. This revenue would not be reversed, right? So this we cannot price at this price. We cannot price them at $154. So we need to move further. We need to find the price where that we can say after this, we are highly probable the price would not change, right? That means we can recognize the revenue at that price. So by looking at the evidences that we have, now we know the maximum that we could in the history, the maximum discount was at 38%. Now we need to choose the price, that discounted price, that would guarantee, that would give us the highly probability that it would not reverse thereafter. So when you look at the historical price concession, the maximum price concession we gave was 38%. But at the same time, the recent market data, the current market data, right? Same time, see, the current market data suggests that the maximum price concession of £35 may be necessary to enable the Starlet company to distribute the goods to the final consumer. That means our recent evidence showing us, right, if you give, if you give maximum 35%, they would manage to sell it to the other party. That means we can get the revenue. One, the goods would be can be sold to the other party, right? So it shows that now out of the 38, and then this is the recent current market data, and the current based on the current market data. The current market data says, if you give a discount of maximum 35% from the price, definitely we can sell the goods to the final consumer. So there will be no need thereafter to no more discount needed. Price no need to be reversed. It is highly the price reversal would not be required, right? That's what we are trying to prove. So here it is most reasonable that the highly probable revenue reversal would not occur at this price of 35, discount the price of 35, right? Now we know out of these two, giving 35% discount is the most reasonable. Out of this, the most likely option, expected value method, was not reasonable for us. So we need to use the most likely out of this here. So we can say now, if you give 35% discount, right? If you give them 35% discount, your price now would be, the price that you're going to charge need to be recognized at $130, right? You take, because 35% means 65 on the 200. So the price you're going to say, for example, 35% means you're going to, so say for example here, how much discount you're going to give, 35% discount on 200, right? 35% on discount on 200. So means your discount going to be 70, and you're going to give a 70 discount. That means from 200 you take off 70, you get 130 as the discounted price. Now this is the price 130. If you recognize your revenue at 130, we can say highly probable the reversal is not required. There will be no reversal, right? Goods will be definitely sold to the other party. So this would be the price that we should have recognized the revenue. So the Luna company must have recognized the revenue at 650, not at 1 million, not at 770, but at 650, right? So if you just come back here, right, if you just take back here, then you just need to say Luna recognized the revenue at 1 million, and this need to be reduced by 350, because you know why? Because they recognize 1 million, right? This need to be, they need to bring that to 650, right? They need to bring that to 650. So how much they need to reduce their revenue by? They need to reduce their revenue by 350,000. If they reduce their revenue by 350, their revenue would be recognized at 650, right? So this is a good questions of application of IFRS 15, which is the revenue recognition, right? So what I've just said, it is pointed out here. You could read the remainder to understand how things are worked out here, right? That's the good example of IFRS 15. Thank you.